Okay, so good afternoon, colleagues. It's my great pleasure to welcome Professor Marcel Prokopczuk, who is visiting us from Leibniz University of Hannover. And today he's going to talk to us about arbitrage opportunity. And he is well-renowned in finance, especially in commodity market. And we are very much grateful to have you, Prof, at NITheCS. And we're looking forward to your talk.
Oh, thank you so much, NITheCS, and thank you so much for inviting me to give this talk. Great pleasure. My first time to Stellenbosch, the first time to South Africa, so so far I like it very much, although it's a bit hot today, but that's fine. In Germany at the moment we have 0 degrees, so I prefer here. So yeah, as NITheCS said, so the title of my talk is Arbitrage Opportunities. This is joint work with Tobias, who used to be a PhD student of mine, joint PhD program with Macquarie University in Sydney, and who is now a postdoc at my institute in Hannover. So what is this talk about? So as the title said, it's about arbitrage. So I know there are also many students here. So arbitrage is potentially one of the fundamental concepts of finance, because in many financial theory, we essentially assume that arbitrage does not exist. This is an assumption, and of course, why does arbitrage not exist? Because arbitrageurs, so-called arbitrageurs, will trade to make any arbitrage opportunity disappear. And the objective of our research study is to basically put the financial markets under the microscope and to see how the market really works. When do arbitrage opportunities appear, and then how do they disappear? And this we do, as I said, under the microscope. That means we look at the market at the highest possible frequency, and that means not daily. That also means not hourly, and that also means not every 5 minutes, but it means every instant, every trade we observe, not even every trade, but also every quote. So I will get to that later, because in the markets we have market orders and limit orders, and we look at all of these orders, so every single order in the market, to see what's going on in the market. So this is the highest possible frequency you can imagine. So, or you can also say that is the best microscope you can get to analyze the financial markets. You can't do more. So this is the idea. So let me first get into the basics. So the basics of arbitrage. So the basic arbitrage, basically in the classroom you learn, okay, arbitrage is if you can sell basically the same asset, or you can buy it at a low price and sell it at a higher price without any risk. And then you generate risk-free profit, okay? And that sounds, of course, cool, okay? So if I offer you a risk-free profit, who doesn't want to take it? Probably everybody. So the fundamental assumption for that is simply that everybody of us prefers more money over less money. Okay? And this assumption is well justified, because, I mean, if you prefer less money over more money, it's very simple. Then I can make your life much better. After my talk, you come to me, or you open your wallet and give me all your money. And if you prefer less over more, then you would feel better afterwards. Most likely that's not the case for all of you. So all of you prefer more over less. And if there's an arbitrage opportunity, you would, of course, exploit that, or you would try to exploit it, let's say. Now, in financial markets, it's a bit more, it's not that simple that we simply say, okay, that we have an asset that has 2 prices, but in the markets, we always have bid and ask prices. So the bid price is essentially price at which a buyer wants to buy, and the ask price is the price a seller offers to sell. And no arbitrage. Oh, that doesn't work. So no arbitrage essentially means that if we have, let's say, we have 2 financial markets, 1 and 2, and then it means, of course, that the selling price in each of the markets must be higher than the buying price. Otherwise, you would already have an arbitrage opportunity in this one single market. But then, of course, what could happen if you have two different markets, that the ask price in one market is below the bid price in the other market, either this or that. Okay, and that would mean that if this is a price somebody is willing to sell, that means you could buy at this price, and this is a price somebody is willing to buy, so that means you're able to sell. So that would mean you can buy at a lower price, sell at the higher price, and this is the arbitrage. Okay, and you would realize an instant profit without having any exposure to risk. Now, as I already mentioned, in your textbook or in any textbook, it says, okay, arbitrage does not, once an arbitrage appears, it will disappear immediately because so-called arbitrageurs will trade because everybody wants to make more money. So if there is a risk-free profit, then you will try to realize that. But of course, if everybody wants to realize the arbitrage, then there's only one who can realize it, the one who is the fastest. Okay, so if you are slow, then you will not realize it because everybody wants to have it. And if everybody wants to have it, then of course the fastest player in the game will be the one who can make the arbitrage happen. And of course, also the one with the lowest transaction cost. Because also in the textbook, usually we assume transaction costs away. Sometimes you also don't. But if you have transaction costs, then of course, let's say if this is just the difference between the two is just, let's say it's $1 and your transaction costs are $2, then in the real world, it wouldn't be an arbitrage because you would have transaction costs of $2 for an arbitrage, which is $1. So that also wouldn't be very helpful. So that means the one trader in the market with the lowest transaction cost would be the one who will exploit the arbitrage first. And once he or she is doing that, it will disappear again. Okay, so these are the basics of arbitrage. And of course, the whole concept of arbitrage is a bit of a paradox because on the one hand, we say arbitrage opportunities do not exist because everybody, if there were an arbitrage opportunity, everybody would want to exploit that. But then, if there's no arbitrage opportunity, why would any arbitrageur try to exploit an arbitrage opportunity if there's no arbitrage opportunity? Because exploiting arbitrage opportunities is also not free of cost. We have to observe the market, what is going on. So you can also play golf or do something else at the same point in time. So, and if there is no, of course, if you knew there were good arbitrage opportunities, you would be willing to do so. But if we say there are no arbitrage opportunities, then of course it's pointless to do that. And as I said, in this study, we really look at with a microscope in the market to see whether there are arbitrage opportunities and how they are dissolved, and whether in the end, probably the assumption of no arbitrage, which you use in your financial models also is justified. Okay, now these are the basics. Now today, the world looks even a bit different than it looked like 10 years ago, because up until 10, 15 years ago, depending on which market we look at, financial market, most of the trading were done by humans in the pit, what we call the pit. You know, if you don't look at the exchange, I'm sure you also have a South African stock exchange or some other exchanges. Then in the past, there were people waving with their arms and making some signs, and that was basically the trading. This is not happening anymore. If you look into the New York, into the trading floor, there's no person and nobody anymore. It's just an empty room. But what's going on today is that computers are trading. So computer algorithms are trading. So very advanced algorithms. And of course, the computers are much faster than humans. If the algorithm observes an arbitrage opportunity, then the computer can immediately trade. And most likely, much faster, or not most likely, for sure, much faster than any human could do that. Okay? And this is also one of the contributions of our study, because of course there have been other research papers that have looked into arbitrage opportunities in different markets, but mostly still under the regime of human trading. And of course, then probably markets were much slower. profits to be made probably bigger. And we want to look at this really new world where computer algorithms submit their orders in much less than a second. Okay. Now in the markets, we also have to be aware of that, as if you have traded yourself at some point, then you might know that that there are two ways to trade, at least two ways to trade in the market, but these are the major ways. If you want to buy or sell, then you can either submit a so-called market order. So that means you are willing to buy or sell at the offered price. So either you sell at the bid or you buy at the ask immediately. Okay. Then you don't have any execution risk because your order will be executed for sure. And that's why this order is then also very fast. So if you are interested in trading very fast and making sure that your order is also executed, then you would submit a market order. But then there are also other market participants who provide what we call provide liquidity to the market. So somebody must provide the bid and the ask quote. So these are just quotes, not trades. So I offer to buy or I offer to sell at a certain quantity at a certain price. Okay, and these are so-called, as I said, liquidity providers, because they offer liquidity to the market. They offer the other participants who want to submit market orders. They offer them the opportunity to do so, and so that means these so-called limit orders. So you offer to buy or sell at a limited price. There you have no guarantee that they are executed because you just make an offer. And if there's nobody taking on the offer, there will be no trade. Okay. And one of the big focus in our study is to see whether if there's an arbitrage opportunity in the market. Okay. So that means there are bid and ask prices that offer an arbitrage opportunity. What happens then? Once we observe, if we observe, first question is, do we observe arbitrage opportunities? But okay, you can already imagine the answer will be yes. Otherwise, the study would be very boring. But if we observe these, what happens then? Are there really traders, people who exploit the arbitrage opportunity and make money? Or what can also happen is that simply the liquidity providers adjust their quotes. So let's say you have offered before to sell at 100, and that would, for whatever reason, be an arbitrage opportunity. You could also simply adjust your quote and say, no, I'm not willing to sell for 100 anymore, just for 101. And that would eliminate the arbitrage opportunity without anybody making any money. So and this is the key question we want to look at. How are arbitrage opportunities dissolved in the market? So these are our research questions. So when do tradable arbitrage opportunities emerge? So this is important. So in the real world, are they really tradable? And if we observe arbitrage opportunity, as I said, we need at least two markets to have an arbitrage opportunity, and we will look at the crude oil futures and option markets. So if we observe an arbitrage opportunity, then of course two things can happen. Either in one market, let's say the arbitrage means in one market the price is too low, and in the other market the price is too high. And now the question is, there are two possibilities. What can happen? Either the price in one market increases, or the price in the other market decreases, or both, to make this arbitrage disappear. And we want to see which market really moves. Is it the futures market or is it the options market? So because both is, or both, of course. So how are they eliminated? So that means, what does it mean? How? This is exactly the question I mentioned. Is it tradable orders? So are they real trades? Is somebody really making money? Or are the market makers adjusting their quotes? So to make this disappear. And by the way, if you have any question during my talk, just simply ask. I forgot to say that. And then the final question we asked, so once in a while we see a long-lived arbitrage opportunity. And when I say long-lived, I'm talking about seconds, not hours. But that means, so we say, okay, when we see a long-lived arbitrage opportunities, the market efficiency breaks down. And the question is, why is this happening? Okay, why are people not exploiting these arbitrage opportunities? Because this would mean then that the assumption of no arbitrage in many fundamental financial models is not valid anymore. Okay, so I have also, there's of course, as I said, there's also this arbitrage is the holy grail of financial markets. So of course, there have been many studies also on that before. So first, very old paper from 1995, where basically these authors argue, okay, even if you observe so-called arbitrage opportunities, then this might be just caused by dividends or early exercise. If we have an American option, we have to take this into account. And if you are at a low frequency, you have no way to detect that really. So then there's also a theoretical paper, a very famous seminal paper by Schleifer and Vishny, where they basically say, okay, arbitrage in theory should not exist, but in reality, arbitrage might still occur because trading is risky. So, so this is what we call limits to arbitrage. So there might be times when, for example, risk is very high, where market participants stop trading even on arbitrage opportunities. This is what I meant with this last bullet point here, is under which situation do we observe that the concept of no arbitrage, the elimination of arbitrage, breaks down. And that has, of course, important policy implications, how we operate and regulate the financial market. Because, of course, we are all not everybody, but from an economic point of view, from a welfare point of view, we want to have a functioning financial market, efficient financial market. So then also some older papers where they talk about the importance of sampling the data price observations at the same point in time. Because as I said, I buy in one market, I sell in the other market. If there's a long time gap between these two instances, there's a lot of risk involved. And of course, in these days, I mean, in 86 for sure, but also in 2006, they were just working with daily data, for example. So very low frequency. So if you have to wait, so if you buy today and you sell tomorrow, then a lot can happen overnight, but also just within 1 hour. And then it's not a real arbitrage. A real arbitrage means no risk whatsoever, in theory. Yeah, so then we also have this a bit older paper where they say, okay, price discovery takes mainly place in limit orders, but there they still look at markets dominated by humans, not by machines. And so this is also older paper. Oops. Yeah, and some other relevant literature where they look at different markets. For example, in the last one here, they look at the market for ETFs, so exchange traded funds, where an arbitrage could also emerge if the stocks or the assets in the fund, the basket, trades at a different price than the ETF. But of course, in this market, trading on this arbitrage opportunity is much more difficult, because if you have a stock index with 100 stocks, then you would need to trade the 100 stocks against the index, which is costly and probably and most likely not so easy to realize. And that's why also we look at the market for crude oil futures and options, because this is a super liquid market, and it's also both. These assets are traded on the same electronic trading platform in Chicago. And so that means that if you are a trader, then you are in one system and you can trade both these securities in the same system at the same instant. Okay. At the moment you trade at two different markets, you already have a risk that in one of the markets something happens which is not covered in the other market. And then all these papers also look at a high frequency, but what they mean with a high frequency, for example, they sample in 5-minute intervals. Okay? But what I will show you is that, so as I said, we look at a much higher frequency, and we will see that this is important, because 5 minutes, it's a millennium in terms of financial trading. So in 5 minutes, the world has already, or the financial world has, not the financial world, but an arbitrage has disappeared, I will show you. So it will not last so long, at least not these days where we have machines trading. Okay, so just for those of you who fall asleep, I want to give you the main results in a nutshell before I go into detail. So what we will see is that we have tiny and short-lived arbitrage opportunities, and with tiny and short-lived, I really mean tiny and short-lived. And these are, because they are so short-lived, most likely eliminated by computer algorithms. So not by humans trading in these markets anymore. And this is probably not surprising, because obvious that you can, I mean, at least at the end of your program, you will be able to program your computer so that the computer will be able to trade on an arbitrage opportunity. Or you can do that even now, but later you can do that. It's not difficult. You just need a good computer, a super fast computer. And most of your computers will not be fast enough, but programming the computer is not difficult. I just need to tell the computer, look at this at one inequality, and if it is fulfilled, then trade. So it's straightforward. But so this is to be expected, but not, of course, not how fast it is. So that's not obvious. But then, as I said, the more interesting bit is from a market microstructure perspective is actually more where and how are the arbitrage opportunities eliminated. And what we will observe is that in the futures market, we observe real trades. So where people really trade, and there is a trade, a buy and a sell. And somebody potentially makes money. But in the option market, the arbitrage opportunity is eliminated by limit orders. So the arbitrage disappears by simply the liquidity provider providing adjusting their quotes. So nobody makes them money. Okay. And we also observe, we have instances where arbitrage, no arbitrage breaks down. And this is especially the case when volatility is high. The option liquidity providers stop quoting, potentially because it's getting too risky for them. Or when futures traders stop submitting marketable orders, potentially also because for some seconds the world is becoming too risky. Yes, so that means in the end, not a lot. So that's bad news, because that's probably why many of you are here. So the main result is also there's not big money to be made. Yeah. So because in a microstructure, we always say the cheapest trade is a trade that never happens. So then you have no transaction cost whatsoever. And by adjusting the quotes, you can basically, there's no trade happening. It's just a new quote. Okay, so let's go now to some very basics. So this is the basics of what we will do. So our approach to look at arbitrage opportunities is what everybody hopefully knows, put call parity. Okay? So this is the relationship between a futures price, put price, and the call price on an underlying with the strike price of K and the maturity of T for these options. Okay? So this is from any options textbook you can get. You know this formula. So we have a put, we have a call, we have the underlying, which is the futures, which has some, and the put and the call have some time to maturity. We have some strike price, and of course, we need also some risk-free interest rate. So this is the idea. And this equation is completely model-free, so we don't need to assume anything. This must hold if there's so that there is no arbitrage. If this equation is violated, there would be an arbitrage opportunity. This is what you all know. But you also might know. I'll manage my thinking. Yeah.
in a second.
Yeah. But I just dropped the microphone, so I haven't destroyed the projector. Okay, thank you. So we are back. So this is put call parity, but you might also know that most of option markets, actually the options are not European style, but American style. So that means there's all the opportunity of early exercise. And if we look at the market for American options, then the put call parity becomes actually a put call inequality. So that means we have now not an equality, but we have a lower and upper bound for the price difference between a call and a put on the same underlying. So this is also completely model free. We don't need to assume anything. The only thing which needs to hold so that this inequality, the two inequalities hold, is no arbitrage. Okay. So that means, of course, I can take this is what you see in most textbooks. And if we want to be more precise, which mostly often not, which is ignored in textbooks, let's say, is that we have bid and ask prices in the real world. So that means to really work with this in the real world, we have always to think about whether we want to buy or sell the call or the put or the futures. Okay, and this is simply the discounted strike price. So this is so now we can take this to this upper inequality, and I simply can now say, okay, I have an upper bound for my difference between the call and the put, the bid price of the call and the put price of the ask. And this is given by this, the ask price of the futures minus the discounted strike price. And then I can also look at the lower bound, which is now the price difference between, or which is governing the price difference between the ask of the call and the bid of the put. Okay, so this is basically these two inequalities must hold, otherwise I have arbitrage opportunity. So now, because as I said, trading is costly, a pure violation of this inequality potentially is not directly an arbitrage opportunity in the real world, because you have to execute the trade, and for that you have to pay something. Okay, so to make this work, we assume, following some other people, and so they assumed basically in this paper they looked at a market for individual stock options 10 years ago, and they assumed 2 cents for a trade, and so we argue that now 10 years later, and in the much more liquid market for crude oil futures and options, transaction costs are likely to be even lower than these 2 cents. Okay, so, but okay, we still use these 2 cents to be on the safe side. This is a conservative estimate of the transaction cost, and that means now to have a violation of our put call inequality, we have to add the transaction cost to the lower part of this leg. Now, what is now the idea? The overall idea is now very simple. In the beginning, I was talking about 2 different markets. We are not for an arbitrage, so same asset in 2 different markets. But of course, this would be a risky trade if I have 2 different markets. If I trade New York versus Tokyo, then I already have risk, because then I have different markets. So here we look at the same market, same trading platform, Globex, so-called Globex, but for 3 different securities, which are tied together by no arbitrage through these 2 inequalities. So the essential idea is if I move this part to the other side of the inequality, or also here, then I basically get the portfolio of the call price, the put price, and the underlying and the strike price, sorry, which is equivalent to the futures. So it's a synthetic portfolio mimicking the payoff of the futures. So that means I have essentially the same asset. It's not the same asset, but I have 2 assets or a portfolio of assets with the same payoff. Okay, And these two assets must have the same price. So this is the definition of no arbitrage. So the idea is now, okay, I can form a synthetic futures price by building a portfolio of call, put, and the strike price. Okay, so that means the risk-free asset, basically. And the idea now is illustrated by this very nice graph, which was not drawn by me, but by Tobias, my co-author. Otherwise, it wouldn't look so nice. So what we have here is we have let's say these are the two futures, the ask and the bid, and the ask is always higher than the bid. Okay, and this is the price that somebody is demanding. This is the price at which somebody wants to buy. Okay, and as I said, this must always be higher than this. But of course, they change over time. And also the spread between the two doesn't need to be the same all the time. But the ask is always higher than the bid. And now I can form a portfolio, a synthetic futures portfolio out of the call, the put, and the risk-free asset. And this can be, so I can form a synthetic future bid price and a synthetic future ask price. And as long as the synthetic ask is higher than the true ask and the synthetic bid is lower than the synthetic true bid and also ask, we have no arbitrage opportunity. But the moment the synthetic future bid gets larger than the ask price, we have exactly the situation what I showed you on the very first slide. Okay, so think about the red and the blue, black at two different markets. So the same asset, it's not the same asset, but it's the same payoff in two different markets. And at the moment the bid in one price market is higher than the ask in the other, or the ask in the one market is lower than the bid in the other, we have the arbitrage opportunity. And this is what we want to look at. We want to look at this point. We want to identify this point in our data. So this is where the arbitrage opportunity starts to exist. Then something is going on here, and we want also and this is what we want to look at. What is going on once there is an arbitrage opportunity until it has disappeared again. Okay. So this is basically what we want to look at. Okay. So what are the variables under interest? So we want first determine occurrence of arbitrage opportunities. Of course, this is interesting per se. But then we also want to see, okay, how long does it last? So basically, how long does it take for the arbitrage to disappear again? And of course, what is the maximum profit, or what kind of profits are available? So, sorry. So it's essentially this. So how much money can be made? This. And then we have some standard variables from the microstructure literature that might explain the occurrence and the size and duration of arbitrage, the trading volume, order imbalance, the slowness of the market. So how often when I say a message is either a trade or a quote adjustment. So this is what we call a message. So something new. The realized volatility, and we measure realized volatility over a 5-minute interval. So, and also the bid-ask spread in these markets, which is a measure of transaction costs or implicit transaction costs. Okay. Now, in terms of then our modeling approach, because we have many days, so we will look at days where arbitrage opportunities occur. So this is our first variable under interest. But we will have many days where there's no arbitrage opportunity. And this is a econometric problem. It's microeconometrics. I don't know whether you're familiar with that. But essentially, we follow here a standard procedure, so-called Heckman approach, where we first estimate a probit model, where the explained variable is a dummy if there is at least an arbitrage opportunity on this specific day. Okay, and then in the second stage, we estimate a linear model with duration and profits on these specific days. And so it's a standard approach. If you have a situation where you have a data set with many zeros as a dependent variable. Okay. Now coming back to what can happening if we observe an arbitrage opportunity. So this is now the inequality flipped around. The inequality I just showed you 10 minutes ago is now flipped around. So that means we have arbitrage opportunity. Now what can happen if there is an arbitrage opportunity? So we need to flip this inequality again. And now this can happen through in three different ways, or a combination of these. Because the concept of arbitrage doesn't always just tell what are the prices of securities relative to each other, not what is the absolute value of an asset. But if we have if we have this situation, so that means the left-hand side is too big, the right-hand side is too small. So that means to flip this around again, the bid price of the call must get lower. How can the bid price of the call get lower? Either somebody really sells at the highest bid price, or the market maker is simply canceling the highest bid. So if this happens, the bid gets lower. So there's a bid price. The market maker says, oh no, I don't sell at this price anymore, I sell at this. And the left-hand side goes down without trade. Or there can be a trade that somebody really sells at the highest bid. The moment somebody sells at the highest bid, this bid also disappears. Because as I said, every bid or every quote is also accompanied with trading volume. And let's say the market maker offers 100 units. The moment somebody sells 100 units at this bid price, the bid price also disappears. As long as the market maker doesn't provide new volume. What can also happen, of course, is similarly that because the put ask is too low or the futures ask is too low, similarly, either there can be a cancel of the lowest bid or buy at the lowest ask. Okay? And as I said, of course, a combination of these can also happen. In theory, what you could also imagine is that this guy here can adjust to make this inequality flip side. But because this is a constant, so the only thing, and because we look at very small time intervals, t, we can also think of a constant. So the only thing that would make this work would be a change in the risk-free interest rate. But we argue, and most people agree to that within a second, the risk-free interest rate doesn't change. Okay, because the central bank is not doing anything in a second. Okay, so this was the upper bound violation. And for the lower bound violation, it's just the same. It's just the inequality looks structurally the same. And of course, again, this is too high, this is too low, and we can have an adjustment to make this be in line again. And as I already mentioned, so now what we will look at, if you think about this is the day, then this is our 2 cents threshold. Okay, so here we have already a violation of the inequality, but we say, okay, it's below 2 cents, so most likely it's not exploitable. Okay, but the moment it is above 2 cents, then we call this an arbitrage opportunity. Okay? And so that means now this would be a day with an arbitrage opportunity, and we would call the duration then of the arbitrage opportunity from the first occurrence to the disappearance. Okay, we call the eliminating orders are those from the peak of the arbitrage opportunity to disappearance, because actually what happens here is that the arbitrage opportunity is getting bigger. So that means that the orders to make the arbitrage opportunity disappear are basically from the peak to the point where they disappear. And the profit we call basically the maximum arbitrage on this specific day. This is the maximum profit you could have realized. So this is just to make this clear. Okay. Okay, so this is what I just said. We look at price changes in both these markets, at the buy and the sell volume, also limit order cancellations, because as I said, these are these quote adjustments, okay, to see how the arbitrage opportunity is eliminated. Okay, if we also. So quickly on the data set we use. So as I already mentioned, we use at the NYMEX WTI sweet crude oil futures and option markets. So this is the most liquid commodity futures and option markets in the world, and one of the most liquid markets in general. So a lot of trading volume in this market. It's NYMEX, but now it's part of the CME, so the Chicago Mercantile Exchange, where these are traded in Globex. This is the electronic trading system of the CME. We look at options at the money options, plus minus 5% around the underlying, and the maturity of 10 to 100 days. So to focus on the most liquid part of the market, because options further out of the money are less liquid. Options with longer maturities are also less liquid, and options with less than 10 days to maturity might be also very illiquid, because nobody is interested anymore in trading an option that is about to expire. But also, most people are not interested in trading options which have a maturity of 5 years. So this is the big market. Okay, so we have the underlying futures, and we look at 2 years, 2019 and 2020. So if you do general time series analysis, that might sound short, but in market microstructure, this is already long. There's a lot of data because we observe every trade and vote at the order frequency. This is in total about 2.8 terabytes of data. So it's quite a lot of data, at least for financial research. And we'll use LIBOR for the risk-free interest rate, but this is not so interesting. Okay, this is what I already mentioned. Why do we look at the WTI market? As I said, so this is one of the most liquid options and futures markets. The advantage is also, in contrast, if you think about what I said and what I showed you in the literature, they looked at ETFs, so where you have to trade individual stocks, for example. To short an individual stock is much more difficult than to short a futures or an option contract. Okay, so derivatives are much easier to short in general, easier to trade. Okay, and most of all, what is very important is that all three securities are traded electronically on the same trading platform. So, and this is of course important if you want to exploit an instant arbitrage opportunity. You want to trade on the same system, okay? Because otherwise, if you submit an order in one system and the other order in another system, you have always the risk that they are not executed at the same point in time, which creates risk. And arbitrage means risk-free profit, so there shouldn't be any risk. And another small advantage is that we had the market stress in April 2020. I don't know, probably you don't know that. So this was a point in time where the market for crude oil futures market, the prices became negative. It is not something standard to happen, because a price to be negative means you have to pay somebody to give him the asset. Okay, this most times does not happen, but it happened in April 2020 in the crude oil market because storage capacities were full. So this is what can happen in a commodity market, not in a pure financial market. This is mostly not happening. But if the storage capacity is full, but you are producing the oil and it has to go somewhere, you might be willing to pay somebody to take it. Okay. So and there we had some market disruptions also in financial trading. Okay, so let's look last 20 minutes, or 15-20 minutes. Let's look at the result. Here I have now the three variables. The first three variables under interest, the number of arbitrage opportunities on each day, okay, the size of the arbitrage opportunities in the market, and the duration. Okay, these were the three variables under interest. So first, what do we observe? In the first, and the top, arbitrage opportunities are not rare. There are arbitrage opportunities in this market. Okay. But also please note the scales here are not linear. They are square root scales to make it look nice on the slide. So then, if an arbitrage opportunity occurs, how big are they? And we can see that many of them are very small, but there are also some big ones. And this is exactly here, April 2020, the point in time which I mentioned. So there we have the biggest arbitrage opportunities. This is $5. But also note that one trade in the WTI market is for 1,000 barrels of oil, not 1 barrel of oil. So that means there you could have made $5,000. Okay. And here we have the duration of the arbitrage opportunities, and you can also see that most of them are really, really small. Only here at this point in time, was the longest one that was for about 3,000 seconds, which is 50 minutes. So this is very, very long. So to summarize the descriptive statistics, so we observe in these 2 years, in total, approximately 40,000 arbitrage opportunities, which sounds like a lot. Yeah, 40,000 times where you could have made money. Okay, that sounds great. But the average life of the arbitrage opportunity was 2.6 seconds. And as you might already imagine from the previous slides, the distribution is heavily skewed to the right. So the median life of the arbitrage opportunity was 0.02 seconds. Okay, so this is the duration of the arbitrage opportunity. The average profit was 3.7 cents. Okay, the median profit 1 cent. Okay, so we are talking really small money here. And here's some more statistic: 11% were longer than 1 second and 8% greater than 0.1 second. So bottom line is that arbitrage opportunities are not rare, but if they occur, they disappear very quickly, very fast, and the amount of money you could have made is tiny. Okay, so this is what we find in this market. Now also, as I said, we now want to analyze a bit what determines these variables. So we run regressions. And the first one is on the occurrence. So this is the first stage, which I mentioned, the probit regression, where the dependent variable is the occurrence of an arbitrage opportunity. And we can always focus on the last column. So we have here standardized regressors, so to make also the size of the coefficients comparable. Okay. And what we can observe is that arbitrage opportunities are more likely to observe if the bid-ask spread in the option market is small. They are also more likely to observe, and this is the most important variable, if the realized volatility in the market is high, so more risk. It's also more likely to observe when the option market is slow and the futures market is fast. Okay, and if the volume in the option market is low and the volume in the futures market is high. So we can already see that there are differences what's going on in the futures and in the option markets, because the coefficients for these 2 markets have opposite signs. So different characteristics what's happening in the option market relative to what is happening in the futures market. Although most likely many traders operate in both of these. If you are an arbitrageur, you have to operate in both of them. But also if you are trading for whatever reason, you might trade, of course, in both of these markets. Now we can also look at the duration. So this is here, and the average profit you made by trading in the arbitrage opportunity, and what determines these. And we can again observe qualitatively similar results. We can see that the higher the volatility, the longer the arbitrage opportunities prevails, and the higher the profit you generated. We can again see a negative coefficients for the bid-ask spread in the option market, and also now for the speed of the option and the futures markets, and also for the volume. So similar as for the occurrence of the arbitrage opportunities, the same variables have the same effect also on the duration and on the maximum profit, which is not unexpected, because the condition to create an arbitrage opportunity would of course be related also to the conditions to make it disappear again. And this is actually determining then how long the arbitrage opportunity prevails and how big it becomes, because this is the maximum profit. Okay, now I want to look at what we think is the most interesting part, if you already know a lot about market microstructure, and this is which market moves and how. This is what I mentioned at the beginning. So is it either the option market or the futures markets where prices adjust? And most interestingly, is it through tradable market orders or limit orders? Because this tells us how the markets really work. Now, this is now the graphs that I will show you in the next minutes all look the same. I mean, the structure is always the same. We have here bins with the size of the arbitrage opportunities. Okay. And then we see here in this gray is the adjustment in the futures market, and the darker one is the adjustment in the option market. Okay, and here we have upper and lower bound violations, but you can already see structurally that looks very similar. So it doesn't seem to matter whether it's a lower bound violation or an upper bound violation, but that's also to be expected, because for a financial trader, it doesn't matter whether it's the one inequality, this first inequality I showed you or the second one. You need to trade in the same assets to make this profit. Okay, and what we can observe is that of course, the larger the available arbitrage profit, the larger the price adjustment. This is by definition. Okay, so that the bars are increasing from left to right is clear. But what we can see is that in both markets we can see price adjustments. Okay. But for most of the time, it's the option market with the larger price adjustment. Only for the very big arbitrage opportunities, we see bigger price adjustments in the futures market. Now, this is a first piece of evidence, but now we also want to look at, as I said, whether it's marketable orders or limit orders that make this price. So these are simply price adjustments. Either it is through a limit or a market order. So we can't tell from this graph what's the difference. And now we look at the different markets and look and see and want to analyze whether, as I said, trade or vote. And this is now this graph is now for the futures market, the upper bound violation, just as an example. And we see now in gray in this graph, these is by volume. So this means real trades. And the dark one, these are limit order is change in the limit order imbalance. So these are essentially adjusted quotes. You can think about it simply the prices change because new quotes, not trades. Okay, and what we can see is that for small to medium-sized arbitrage opportunities, the gray bar is larger than the dark bar. Okay, so that means these are real trades in the futures market that eliminate the arbitrage opportunity. So somebody is really making some money, but small money. But for the larger ones, we also see a lot of stuff going on in the limit order book. Okay, so market makers adjusting their prices. But now, so this is now what's going on in the futures markets. And now we look at the option market. This is now for the put option, but I will show you everything together, and this is structurally similar then. And what we see in the option market is that for most of in all of these bins, the black bar is much bigger than the gray bar. Okay, and this means that in the option market there are almost no market orders eliminating arbitrage opportunities, but the market makers are adjusting their quotes. Okay? So nobody makes money, almost nobody, through trading in the option market. Okay. Okay, so this is now showing, these are the three possible cases. We have upper and lower bound violations, and this is futures, put, and call. But you can see, so probably you can't see, but what you see also from the back is that here in the lower four graphs, almost everything is black. And that means limit orders. Everywhere limit orders in the put and in the call market, whether it's an upper or lower bound violation, market makers are adjusting their quotes. And this looks different for the futures markets, where we also can see trades. But also for the big arbitrage opportunities, also adjustments of quotes. Okay, I think I skipped this in the interest of time. And coming to the last research question we wanted to look at is, when do markets get inefficient? So when do we observe that no arbitrage violations are not corrected? Okay, and to do that, we thought it's interesting to look at simply two cases. So we look at all the arbitrage opportunities that last for more than the tenth of a second, and we look at all arbitrage opportunities that lasted for more than 30 seconds. Okay, and why? Because but of course, I show you some robustness in a second, but we simply say, okay, the computer might need the tenth of a second to submit an order, likely it's faster, and a human being might need 30 seconds to identify the arbitrage opportunity. Probably you are faster, I don't know. You are all very smart and young and quick, but this was just like a random pick. I show you, as I said, robustness. And now we look at our standard variables, and what we can see again that first of all, what we can see is that if you compare these two columns, that the coefficients on the left-hand side are much bigger than on the right-hand side, so they have higher, more impact for these already short-lived arbitrage opportunities, and we can see that realized volatility is again important. The speed in the option market is very important, and also the time to maturity of the contracts. Okay, so the higher the longer the time to maturity, the longer the more likely it is that the market does not immediately correct the arbitrage opportunity. So that means if you were to look for arbitrage opportunity trading, look at the options and the futures with the longer maturities, but then you of course also have again the risk of less liquidity. So it's not unexpected, this result. So as I just said, this 0.1 second and 30 seconds was an arbitrary choice. So we now did the same analysis for 1,000 different durations of the arbitrage opportunity. So 1,000 regressions for each case. And these are now the coefficients for these, basically starting from 0. This is the 0.1 second and these are the 30 seconds. And this basically just confirms that our choices of the 0.1 and 30, which were random, are not so important for the main result. So we can see here that realized volatility is really important for the short-lived, getting less important here. We see that the speed of the option market is really important to determine the duration of arbitrage opportunities, and also the time to maturity for the of the contract is important, but not so much for the longer arbitrage opportunities, but very much for the short-lived ones. So which means that probably that the algorithms focus on shorter maturities to identify and eliminate arbitrage opportunities. Okay, so to conclude, what have we done in the study? We have looked at the financial market with a microscope at the messaging frequency, so the highest frequency you can get, so the highest precision. We see that there are arbitrage opportunities in theory, but in practice that they are not executed via immediate trades where somebody made a lot of money, or not a lot, but at least some money. But in the relatively less liquid option markets, limit orders dominate the price adjustment. In futures markets, this is dominated by prices. But if you really want to make real money with arbitrage, you would need to have real trades in all three markets to make money. Okay, so most likely, arbitrageurs combine limit and marketable orders across markets, so to limit their risk through limit orders in some markets and still make some small, very tiny amount of money in with marketable orders. But overall, the profits to be made are very limited. So we see actually what we might have already expected. I don't know what you might have expected, but we see that there are arbitrage opportunities, but they are immediately eliminated, mostly through quotes, adjusted quotes. So that means there's not a lot of money to be made, but there are people who make sure that that markets remain arbitrage. Okay. Oh, thank you very much.
Questions to Prof Marcel?
Yes.
I'd like to ask, actually, this goes in, two questions go together. When it comes to all these arbitrage opportunities, if you would plot all the opportunities coming up until 2026, let's say all the way back to 2000, is there a downward trend in all the opportunities? Basically, all the investing into AI and these supercomputers.
Yeah, I mean, I can't answer. I mean, not for. I don't have the data for this long period. The problem is, so this high frequency trading only started like 10, 15 years ago, and only then we have also available data. Of course, I can also look at the lower frequency, but then you have all these issues that what might have been called an arbitrage, but it wasn't really an arbitrage opportunity, because if you have to wait for one day to for your order to be executed, it's not risk-free. So in that sense, yes, the potential profits most likely have been driven down quite a bit, but that potential profit in the past probably also wasn't a true arbitrage opportunity.
Additionally, though, would you say though now if you put, let's say, if you accumulated more data, or at least just tried to look into the future with obviously constant investing into supercomputers, into AI, would you say that there would come a point into the market where arbitrage is absolutely not possible?
I mean, I think that somewhere there will be an equilibrium, because, and probably we are already pretty close to that, because, oh no, I don't have good graph, because, probably I go there. So, the median profit is 1 cent, okay, which you could have realized. And okay, I assume trading cost of 2 cents, but of course you need also a good computer, and this computer is costly, and you need energy also for this computer. So eventually, this can't get much smaller, because you still need to make at least enough money to pay for your computer. So at some point we will reach an equilibrium where it doesn't pay off anymore to buy a better computer. I mean, these computers, they are basically placed next to the exchange. Okay, because otherwise your orders are too slow. If you submit an order here from South Africa to Chicago, you will never exploit anything, because it's too slow. How fast does it travel to Chicago, your order? I mean, I'm not a physicist, but I think it's the speed of light. This is pretty fast, but it will be too slow. So you have to be, your computer must be hosted there, and that's also costly. So yeah, so eventually we have already reached a point where we're very close to an equilibrium.
There's not really any proper opportunities available in arbitrage.
I mean, this is what you have made and could have made in 2019 and 2020 in this one market. Of course, there are many markets, but you can see that this is. I don't know whether that's worthwhile your efforts. Of course, if you do this large scale, then it's still money to be made. But as we said, you also have costs. So I would say, as a normal investor and everything, no way that you make any money with this. You have to have your specialized supercomputer, and then you make tiny profits, but that need to pay for your investments also.
Any other? The 2020 pandemic had impact on causing the market stress that happened in April.
So I didn't get it. Is it about the pandemic?
Yes, did it have impact on the market stress that took place?
I mean, I don't know, but here mostly not so. I mean, of course, the pandemic had impact on everything most likely, because it has an impact on our lives. So everybody was affected, but because here we talk about electronic trading and computers trading. So you don't need to go to physically go anywhere. Of course, you need to go physically to your computer to program it, or you can also do that remotely. And if you are sick or your parents are in a hospital, then you're also distracted. So that what I meant is the pandemic has effect everywhere. But most likely the electronic trading can simply continue, even if we are in a lockdown. So, but of course, the pandemic had the impact on everything.
From my side, I'm mostly on geoscience, so I don't know much about markets. So, but my question is, from what I've seen, for my side, let's say I'm wearing a market boy cap.
Yeah.
So I see a lot of impulsiveness based on the time, on the speed that you talked about, on that the systems,
Yeah.
which means with a spike of news, there's a impulse of the way you said it. They're all algorithms.
Yeah.
They're all algorithms set out to buy and sell.
Yeah.
Now, what spikes them, which means it's the news. So if I'm Bloomberg and I realize that, okay, in Russia, there's an oil hub exploded.
Yeah.
And everyone in this room, their systems or their algorithms depend on me to tell them when to act. Why don't I just trade first and eat the arbitrage? Just say, why don't I just eat the arbitrage?
Yeah, everybody tries to get the arbitrage first, but that means the one who is fastest. The moment there's one cent to be made, it's like this. If you see 1 cent on the street, so the one who picks it up the first has it, and then it's gone.
100% I'm with you.
And if there's 100 bucks on the street, then everybody tries probably a bit harder to get it.
I'm just saying, so far as the news guy,
Yeah.
as the people subscribe,
Yeah.
big companies, institutions subscribe on me for newsfeed.
Yeah.
I'm saying before I feed you that info as Bloomberg,
Yeah.
what stops me to have my internal?
Oh, they're very simple, because Bloomberg has no monopoly. If Bloomberg were the only one to have information and to provide information to the traders, then of course Bloomberg will simply first exploit the information by themselves. But there are other information providers. There's no, they don't have a monopoly. So you can get the same information from somewhere else.
Yeah.
It's also the market for information. It's a big market. It's a very competitive market. Yeah? So of course you could try to do that, but might not work because of competition.
3 questions online. Just go through them quickly.
Yeah.
The first one: how is the high frequency exploited in cases where we want to think long term?
Sorry, I didn't.
How is the high frequency exploited in cases where we want to think long term?
So what do you mean with long term? Meaning long term? I mean that's the arbitrage is available for long term or in the future?
I'm just reading the question.
Okay. So I mean, then my interpretation would be in the long term, like what's to be expected in the future. And I think this is similar to a question we already had. Is that but that's just my guess. So I don't know what the future will bring. But that now with the speed of trading, we are already very, very fast, and I don't think it will. And the arbitrage profits, I call them not real profits, but theoretical profits, are already so tiny that, as I already said, the cost of exploiting these or correcting the prices might be already at a level that it's not worthwhile anymore to invest more.
Next question is, so if arbitrage opportunities disappear as quickly as they appear, is it worth looking at them as a small player?
Yeah, so that was actually what I mentioned at the very beginning, the paradox, that and the answer is no, it's not worthwhile as a small. So you are competing against I don't know, Goldman Sachs, JP Morgan, and even more specialized traders, because this is not the main business model of the big banks. No, as a individual, for sure, no, and even as a smaller business trader, you have no chance, not whatsoever.
Last one. It sounds like there's some emphasis on time and execution. How big of a role does this play in affecting arbitrage opportunities, and how best do participants in the market reduce information latency?
Okay, so I didn't fully get that. That was a long question. Can you say that again?
It sounds like there's some emphasis on time and execution. How big of a role does this play in affecting arbitrage opportunities, and how best do participants in the market reduce the information latency?
So, I mean, in terms of information latency, this is exactly why we look at this market, because we have 3 securities that are affected by the same information. So it's all information in the crude oil market in general, and it's all traded on the same platform. So that means if we have any latency, then it's the same for all securities. I don't know whether this answers the question, but I want to emphasize that there's no latency problem in the sense that we have different latencies in the different markets and different executions, because we have the same, it's all on Globex, it's the same system and the same basically asset on which the securities are written. But I'm not sure I've answered the question, but
I think for the interest of time, so we can discuss over.
There is somebody online that wants to, I gave him the rights to speak, so we can maybe just ask Beasley to unmute himself and ask his question.
Yeah.
Thank you very much for the opportunity. Thanks very much for the presentation. Okay, I just had two questions. The first one is on why do eliminating orders occur at the peak, not exactly where the arbitrage opportunity begins, but at the peak of the arbitrage opportunity? I saw there was a visual representation, and they pointed out that they account at the peak. And then the last one is in the general way, how do these results aid to the efficient market hypothesis? Those are my two questions. Thank you.
So I had some problems getting this because the aircon is also running here. So
it's okay. It's okay. It was inaudible.
oh yeah, I couldn't get it.
Yeah, it's okay. I can ask him to email us the question. We can
Yeah,
take it
so I'm happy to answer also